It doesn't have to crash. It just has to slow down. That's going to be the basis for what this video is about, because the last couple of weeks generally and the last 48 hours specifically have been dizzyingly confusing. We've seen semiconductor stocks fall by as much as almost 50%, while a lot of other stocks just today, those very same ones, are up by double-digit percentages. Let's explain what's going on here. My name is Brian Stoffel, and the question on the tip of everyone's tongue for it seems like the past couple of months has been this: is AI a bubble? But it can't be answered, and it doesn't help you. Nobody has really ever gotten rich by answering it. This is the question that can be answered, and every argument that you hear is downstream of this: who is lending to whom? And against what? So what I'm going to be doing today is I'm going to be giving you a lesson that matches exactly what happens inside of my investing community, Stock Investing Mentor. I don't normally do this, but extreme times call for, let's say, extreme measures. My goal is that if you watch this video all the way to the end, you'll be able to understand how circular financing could evolve in a bear case, in a base case, and in a bull case. And here's why this matters. Because circular financing has the potential to supercharge results. This should not be surprising news. However, those results can go both ways. I said supercharge results, not good or bad results. So if I, let's say, fund a company, it buys my stuff and then becomes self-sufficient, all I've done is seeded my next big customer. That's a great thing. But if I fund another company, it buys my stuff, and then it collapses, well, I've not only wasted capital, but I've somewhat artificially, legally, but artificially inflated my own growth rate, which investors never love to do. Now, again, this is an entire lesson that was just presented in my community, Stock Investing Mentor. If you'd like to become a member, it comes in 3 parts. The first pillar is that you get real-time access to my portfolio. Every move I make, 90% of my family's net worth right there for you. Number 2 is you get access to the anti-fragile stock universe. That's all the companies I own and those I follow, ranked by anti-fragility and valuation. Third, you get 24/7 access to an investing community and 1 hour of live weekly training that's recorded as well. And not only that, but you also get access to Stock Simplifier Pro for free. That is a $400 value for free. So if you'd like 10% off of this entire package, the link in the show notes below will bring you right there. Now, the way that we're going to teach this is via analogy. So if you're already well versed in circular financing and AI, this might seem repetitive. But for most people, it might be difficult to understand what's going on. So we're going to talk about a fictional soccer player. We're just going to call him the kid, and it could be her. Doesn't really matter. But everyone says that he's the one, the best 15-year-old soccer player that they've ever seen. Lives in Argentina. Scouts have been coming by since he was 11. But to make it in the pros, he has to go. He has to travel from Argentina to Spain. This should sound familiar for all those Messi fans out there. To do this, you've got to pay for housing, schooling, travel, coaches, agents. Nobody in his family can do this on a salary alone. And the cost of that shot is going to be about $100,000 per year. Now, it's important that as we go through this, the rule in this story is that nobody is just giving the kid money. Everyone expects to be repaid, either a certain dollar amount or a certain percentage of whatever he earns at some point in the future when he gets his first big contract. But that's 5 years away. Maybe in the best case scenario, in 3 years, he might turn professional, but it would probably be at least 5 before he lands a contract big enough to pay everyone back. So hold that number, 5 years, because the money is going to move in 1 year increments. So let's talk about year 1, packing up your bags in Argentina, heading out to Spain, $100,000. Mom and dad are going to pay for that, both out of their paychecks and their savings. Importantly, nothing is borrowed. They pay for the entire thing. Now, this is really important. They're the only people in the entire story who can absorb a total loss. If the kid never makes it, they're out real money, and that sucks. but nobody, no bank, no lender can force them to do anything. And that distinction is going to go a long way in deciding the ending. Let's go to year 2. Year 2 starts, year 1 went well. He needs 10% more money. That $100,000 was just enough to get him through year 1, and he doesn't have a big contract, so he needs to fund year 2. There's a bit more travel, slightly better coaching, nothing dramatic. So he sends his people out, and they need to raise $110,000 to pay for this. Same idea. He will either be paid back a certain dollar amount or they will be paid back a certain dollar amount or a certain percentage of whatever he earns in the future. So they're aiming to raise $110,000, but they raise $165,000. Their raise jumped 65%. He asked for 110, got 165, not because he needed it, but because people were afraid of missing out on him. And everyone wants a piece. That makes sense. He's the next big thing. But he doesn't give that extra $55,000 back. He spends it, which makes sense. His team enters more tournaments. He hires a nutritionist. All of it's defensible, but importantly, all of it is permanent. So that $165,000 in year 2 becomes the new normal. The next year doesn't get measured against $110,000. It's measured against $165,000. So that overfunding didn't buy the kid safety. It raised the floor. And the floor is what's going to need to be refinanced every 12 months. So where did that $165,000 come from? Well, a gear company, a small gear company. Think Nike when it was first getting started with Phil Knight. They're trying to grow. And this kid, the kid, is the biggest name they've ever put their logo on. So they give him $40,000. That's about a quarter of his funding for year 2. And he turns around and takes a lot of that, $25,000, and buys gear from the company to help himself out in year 2. Their gear. Now, let's walk around the circle. The gear company, our young Nike, let's say, has cash that it's giving to the kid, and the kid is taking a huge chunk of that cash and turning around and making purchases of gear from that company. Their sales are up, but their sales are up because of their own money. Now, nobody's lying here. The gear really does get shipped. The revenue's real. It'll pass an audit. But if you're planning to pay a premium for that company's growth rate, you should know who funded the customer, because it's going to show up as revenue on the income statement and as an investment on the balance sheet. But it's not just the gear company. His trainer is building a facility. Now, his trainer used to have a bunch of other clients, but has gone all in on the kid, gotten rid of everyone else. And he believes that once the kid goes pro, the notoriety that's going to come with having been the kid's trainer is going to be a big deal. So he goes out and he borrows $300,000 against his house and takes out a 5-year loan to build this training facility, because once the kid goes pro and his name is everywhere, then he's going to be inundated with clients who are going to be willing to pay top dollar. Now, it's worth noting that his contract with the kid is just a 1-year agreement. One client this trainer has. 5 years of debt structured by a 12-month promise from a teenager. And if the kid stalls, the facility doesn't have a second tenant, but the bank is still going to want their money back on schedule. Let's move to year 3. There's more travel, more higher level tournaments, and all the extra things that were layered in year 2 now have to be spent in year 3 as well. So the new baseline, he needs 30% more, is $215,000. So as people go out and they raise $215,000. He needed a 30% raise. He got exactly that number. Not a single dollar over. Same kid. Talent is great. Scouting says he's still doing well. Last year, he was oversubscribed by a ton. This year, he clears the bar, but by nothing. Year 4. He needs 25% more. That's $269,000 for year 4. You can see how things have spiraled here a little bit. That's 3 times what year 1 costs. Now, he's still at best, the way things have gone over the last 3 years, not terrible, not the best ever, still pretty good. He's still at best 15 months from a professional contract. He needs $269, but he raises $258. So he needed a 25% raise. He got a 20% raise, so he was short $11,000. There was a 5% gap. He didn't get injured. He didn't get worse. he missed a funding target by just 5%. And every single person who has ever put money into this kid is now doing the same arithmetic at the same time. The gear company, the trainer, the private backers. They're now starting to wonder if their money might be in trouble. And not just them, but the bank who lent it to the trainer might be wondering that as well. Nothing else changed. His raises increased by 65% from year 1 to 2, 30%, followed by 20%. The gray is what he needed, and the lines show what he got. He got more every single year, just less more. His funding never fell. Right through the year, it broke. The level was fine. The rate of change was the tell. And it had been deteriorating for 2 years before anything went wrong. Now, of course, this isn't about soccer. It was just a way of layering this in. The kid are the labs. Who are the labs? Well, primarily, we'll just keep it to a couple names, but there's more than this. The labs are Anthropic, OpenAI, Claude, ChatGPT. Burning cash, raising a bigger round each year against a story about what they are going to become. Mom and dad, those are the hyperscalers. Microsoft, Google, Amazon, Meta. Paying for these things out of what they earn from the businesses that they already have. Very impressive businesses. These are the big four players. The gear company. Those are companies like Nvidia and AMD. We'll get to them in just a minute. The other backers are private credit like SoftBank, sovereign funds, securitized debt. The trainer is like the neoclouds. They're borrowing money to build, and they've only got a few real customers. We're talking about Iron, Nebius, CoreWeave. And going pro is like turning a profit, and a massive profit as well. So I'll leave this on the screen for a second so you can just get a feel for who each of these players represent. Now let's take stock of where we're actually at here. Let's talk about the kid. OpenAI, okay? Now, the kid is earning annualized, as of last month, about $25 billion, which is impressive because when the year started, it was about $12 billion. Now it was up to $25 billion. We've heard in the last 24 hours that they had more new net ARR in July, which isn't even over yet, than they had in all of April, May, and June combined. So that $25 billion is probably even more now, which is great. But we have to remember that almost $1.2 trillion. This is what OpenAI has committed to spend on infrastructures through the early 2030s. And that's to Broadcom, Oracle, Microsoft, Nvidia, AMD, AWS, CoreWeave. Roughly 80 to 100 billion a year comes due over the next 5 years against $25 to $30 billion in revenue, an annual run rate. And not only that, that's their revenue. They are losing about $14 billion this year. And outside estimates don't have them being cash flow positive until 2029 or 2030. Now that could change, but we're just trying to set the table here. So their revenue might be 25 to 30 billion, but they're committed to spend about 90 billion every year for the next couple. That's an untenable situation. Let's talk about the parents. We'll talk about Microsoft specifically, okay? They, before they reported last night, had a $625 billion backlog. Now, that was as of that was as of the last quarter. It was up from 392 billion before that and less than 300 billion a year before. But at the time, 45% of it came from one customer. And guess who that customer is? OpenAI. You better believe Microsoft is happy that OpenAI announced that their July has been going very well. But about a quarter of that backlog converts to revenue in the next 12 months, which means that 3/4 of its backlog is a promise about years that we can't see yet. Now, of course, the direction, the news we've had in the last 24 hours is good news. But that's important to remember because across the big clouds, the hyperscalers, OpenAI and Anthropic together are about half of a $2 trillion pie of backlog. And it's important to remember that backlog is a promise. And hopefully all these promises get kept, but it's not cash. Now, in April, some people were starting to wonder if the kid is in trouble. that being OpenAI. Why? Because OpenAI reportedly came in light on internal user and revenue targets for 2026. The last 24 hours have offered a different picture. But it's worth remembering that this changes quickly, and a lot is riding on how the kid, OpenAI and Anthropic, perform. Let's talk about a trainer. In this case, we'll talk about CoreWeave. Okay? CoreWeave's contracted backlog is about $100 billion. So they need to build out these data centers and get their GPUs in it. And so they borrowed $25 billion. Now, the thing is that roughly 47% of that is going to mature by the end of next year, which is almost $12 billion that's going to come due. Now, the company doesn't have the ability to pay that off right now. Their capital expenditures alone eat up all of their operating cash flow. So what's going to happen? Because at CoreWeave, 98% of that backlog of those take-or-pay contracts are from just 4 customers. Now, Microsoft and Meta are well-heeled customers, but who are the other 2? OpenAI and Anthropic. Now, if OpenAI and Anthropic are doing really well, if everyone believes the kid's going to go pro and become the next Messi, they should have no problem restructuring that debt in a way that they can be sustainable until they become profitable. But if the kid gets injured, or if OpenAI and Anthropic run into trouble, whether it's internal trouble, softening demand, Chinese open source models, what have you, well, then that can make it much more difficult to restructure that debt. Let's talk about a gear company, the big one being Nvidia, okay? Nvidia is contractually obligated through April of 2032 to buy CoreWeave's unsold compute if nobody else will. That's on top of $2 billion in equity invested into CoreWeave, even more into Nebius, and up to $100 billion or more, depending on an announcement that came at the beginning of this week, into OpenAI. So let's think about that. Same company, Nvidia, which I own shares of, is playing all 3 of these roles, selling the GPUs, lending money to buy the GPUs, and being the last buyer in case those GPUs aren't used. That's why circular is the right word rather than bubble. So this isn't me saying that this is bound to fail. In fact, that's not what I'm saying at all. There is a definite bull case, and the last 24 hours have shown us this bull case. In this bull case, the kid becomes the next Messi. He gets a huge contract early. Everyone gets paid back several times over. Nobody ever asks whether the money was well spent. And in the market, this would be like the labs turning profitable, markedly so, before the funding cycle turns. All of the backlog converts on schedule, and the levered names, especially the neoclouds, Nebius, CoreWeave, Iron, they win the biggest because they have the most at stake. The smartest investors are the ones who go big time into those neoclouds. In the base case, our soccer player is good, but not special. He makes it. He's a solid professional. But the one problem was a wave of players come out of China's national program, arriving at the same time that the kid does on the professional scene, doing what he does, not needing as much money. That's like the open weight models, although we don't know how that's going to turn out. Those open weight models might create even more demand. It takes 11 years to pay everybody back. So the important thing is everyone gets paid back, but over a longer time frame that they would have liked, probably not the return on investment that they would have hoped for, but nothing fatal either. And then let's think about the bear case, because the money stops first. He doesn't fail. The financing stops. The gap is enough. The backers stop adding because they get scared. And so they're saying, I'm not going to fund year 4 or year 5. And that puts a lot of pressure on the kid. And then things start to snowball from there. The bank calls in the trainer's loan. The facility gets sold into a market that doesn't want it. The trainer gets wiped out. In this case, that would be Iron, Nebius, CoreWeave. And the late backers lose the most. Now, mom and dad are bruised. They spent real money, got nothing back, but they never borrowed, so nobody can force them to sell at the bottom. That historically has been where Meta, Amazon, Microsoft, Alphabet are. They've spent real money, they could get nothing, but they never borrowed. Except for one more thing, that starting this quarter, mom and dad really are borrowing. In fact, if we look at the last 12 months at Amazon and Alphabet, these companies have been spending more than they've taken in from cash from operations. And all of them are expected to be in that same boat by the end of the year, by December of 2026. So they are now borrowing, which is something new that we haven't seen before. So again, this is not me saying that everything's going to collapse or that you should go out and put 20% of your portfolio into neoclouds. Here are the things that I'm going to be watching. First and foremost, above all else, is the kid, Anthropic and OpenAI. I don't think it's a coincidence that we find out that their ARR is doing as well as we did and the market is doing what it's doing today on a day like today, Thursday, July 30th, where many of these names are up double digits. And if and when these companies do file to come public, the information that we see for them is going to drive a lot of what we see in everyone else. With the trainer, what am I going to be watching? I'm going to be watching that $12 billion that CoreWeave has to pay off by the end of 2027. Again, if they get good financing terms, they can roll that just fine. But if they don't, they're going to be in trouble. Mom and dad, the hyperscalers, I'm going to be paying super close attention to their revisions to capital expenditures. Google has already said that they're going to up it. Meta upped it ever so slightly at the midpoint. Microsoft refused to give any commentary on their next fiscal year. Amazon will be reporting shortly. It's not the level of the funding, it's the direction of the funding that's really going to matter. And the last thing that I'm going to watch are the H100 rental rates. Those are Nvidia's GPUs because a lot of these neoclouds have them and they rent them out. So DigitalOcean announced that on August 1st, this is what they're doing to their H100 rental rates. And you can see that they're going up. That's a great sign for anyone invested in this trade. So right now, it seems that the kid is okay and that this is working out. But it is important to remember, and again, I'm not saying anyone should do one thing or the other, that this doesn't have to crash. It just has to slow down before the kid goes pro, before OpenAI and Anthropic become self-funding. So I hope this does a good job of explaining kind of everything that's been going on in the market, from Nvidia's debt, the cost to secure Nvidia's debt going up at the beginning of the week and the cascade that happened from there, to the huge bounce that's happening right now after we got news from Microsoft that was very encouraging about their earnings, and from OpenAI. Let me know what you think in the comment section below. And don't forget, if you'd like to join Stock Investing Mentor, top link in the show notes below. Until next time, Brian